The July 31st tax deadline is behind us, but not for everyone. If you earn from consulting, freelancing, F&O trading, or even content creation, August 31st could be the date that matters. And getting the form, turnover, or disclosures wrong could cost you more than just a penalty. My colleague Preeti K of ET Wealth talks to Aarti Raote, partner at Deloitte, to understand who needs to file their tax returns by August 31st, how F&O consulting and freelance income change the rules, and the costly mistakes taxpayers with multiple sources of income need to avoid. It's Thursday, the 20th of August. I'm Anirban Chaudhary. This is the Morning Brief.
Welcome to the Morning Brief, Ms. Raote. It's a pleasure to have you with us today. So, usually individual taxpayers who are not subject to tax audit do not have much to do in August because most would have completed their return filing exercise by July 31st. But things are a bit different this year thanks to the staggered deadlines announced in Budget 2026 in February. So, which means that certain taxpayers can in fact file their returns until August 31st this year. So, if you could start our discussion with this change, could you explain which category of taxpayers should complete the return filing process by August 31st?
Hey Preeti, great to be on your show. And thank you for bringing up this topic because this has been a change which has been brought in this current year. The July 31st deadline would apply to individuals who normally have only salary income or income from other sources. But for people who have income from business and profession, where there is no requirement to have a tax audit done, those are the people who have to file their returns by the 31st of August. So maybe just a little bit of information about what is a tax audit, right? The income tax law requires a tax audit to be done if your business turnover is exceeding 1 crore, if you receive all your income in cash, or this limit gets increased to 10 crores if you receive 95% of your receipts through banking channels. So in those cases, tax audit applies. So where you do not have a tax audit, but you have business and professional income, then you will have to file your tax returns by August 31st.
Yeah, and this would include income from futures and options or intraday trading or consulting assignments or even social media creation, right?
Yes, that is correct. That is correct. The law is very clear as far as intraday trading or speculation income or maybe futures and option income is concerned, because that is categorized as business income. So definitely those people have to file their returns by the 31st of August, provided you don't have a tax audit, of course. In the case of, say, consulting income as well, the same condition applies. Professionals who have their gross receipts exceeding 50 lakhs would have a tax audit mandate, and hence they can file their returns later. But where income or gross receipts do not exceed 50 lakhs, those are the people who would need to file their tax returns by the 31st of August.
So if you could focus a bit on salaried taxpayers who also draw income from all these sources that we just discussed, which schedules in the ITR forms and which are the other disclosures that they should bear in mind?
See, salaried taxpayers generally file ITR 1 or 2 because those are the return forms which are prescribed for salary. But when you have income from futures and options or say freelancing work or consulting, it is categorized that you have business income as well. And in which case, you would need to file an ITR 3 or an ITR 4. Now, obviously, as I mentioned, where you have a tax audit, you will file your ITR later. But where you do not have a tax audit applicable to you, you have a small income from these sources, you would need to file your return by 31st of August. So salaried people also get their due date extended to 31st of August, right? Now, futures and options, as I mentioned earlier also, they are treated as business income, and many of the people do this mistake. They kind of offer this income to tax as capital gains, but that is not to be done. This is not capital gains or share sale as you would normally understand. This is business income. So you would need to offer this income or report these transactions in part A of the trading account at item number 12. Now, this here return form is very, very simple. So you have item 12, where 12A and 12B is the place where one can report intraday trading turnover and profit, or 12C and 12D, where people can report turnover and profit and loss account from futures and options trading. Right now, turnover is defined or computed as the aggregate of difference between the sale and the purchase rates. So it is the gain or loss that a person incurs in the normal trading transaction. Now, the aggregate of this difference, irrespective of whether there's a gain or a loss, has to be considered as turnover. So if I just want to give you an example, if a taxpayer has gains from transactions, F&O transactions of say 30 lakhs, but he ends up having losses of 20 lakhs from other transactions, which is F&O as well, then the turnover for him would be 50 lakhs, which is 30 plus 20, right? But the profit for him will be only 10 lakhs, which is 30 minus 20. So this is the way you should compute the turnover and the profit. One more thing to remember is expenses also can be claimed when you are offering this income for tax. So brokerage, commission, charges, any relatable expenses that you incur to earn this income are permitted and are deductible. I have explained in detail for ITR 3, but ITR 4 is a lot more similar and much simpler as well. So I will not repeat that.
All right. And when taxpayers have such multiple sources of income, what are the reconciliation and compliance requirements that they must fulfill? What should they do before they even start filing their returns? For example, tallying their records with AIS, broker statements, and invoices, and so on. Could you talk a bit about that as well? The documentation part.
Absolutely, Preeti. See, we are talking about salaried people who might have, income from these different sources, but it's not a major thing. Today, income tax portal helps with a lot of information which is available to the taxpayers readily. So there is AIS statement, which is the annual information statement that provides a listing of all the taxable and non-taxable financial transactions which the salaried person would have, which the taxpayer would have during the year. There is also 26AS, which reports the taxes, details of taxes withheld or paid by the taxpayer during the period of time, during the year. This is information which is readily available on the tax portal. Apart from that, there is information which the taxpayer would get from other sources. Like, for example, there is Form 16 from the employer. There are detailed statements and annexures provided by the employer as well, explaining what is the sources of income or different deductions that the employee would incur. Then there is bank statements, his own bank statements, because it's possible that smaller interest may have got missed in the AIS statements. So the taxpayer needs to collect all his bank statements. There are brokerage accounts as well that he would have for these futures and option transactions. So those statements as well, he would need to collate. So basically, make a listing of all the sources of income and expenses that he has incurred through the year, collect them, and have a reconciliation done vis-a-vis the information available on the tax portal. I think that is the first step that anyone needs to do. If there is something which is incorrectly reported in the AI statement, the taxpayer also has an option to go back and report that as incorrect and ask for a correction there.
And they can do this on the tax portal itself, right?
Yes.
The income tax filing portal.
Tax portal itself. Because this is going to go a long way in reducing the discrepancies that arise when the centralized processing center will do an auto kind of check of the tax return. So if it is all reconciled at the start, your challenges become lower in future.
Okay. Now coming to selecting the right form, how should they choose between ITR 3 and ITR 4? And how should they ascertain their eligibility for the presumptive taxation scheme?
ITR 3 and ITR 4 both have a facility to report business income. ITR 4 is applicable for the smaller taxpayers where they have an income to be reported which is less than 50 lakhs, right? They can report income on normal basis of presumptive taxation, but capital gains is restricted only to 1.25 lakhs, and you can report only two house property income. So basically, where your income is less than 50 lakhs to be reported, you can use ITR 4. If it is more than 50 lakhs, then you need to use ITR 3.
And if you could talk about the presumptive taxation scheme.
So, the tax laws provide an option to all taxpayers having business income to offer the income to tax in the normal fashion, which is a normal, all the gross receipts minus the expenses, and then you offer the income to tax. So that is a normal way of, computing the profits. Or a presumptive tax where you're presuming that a certain percentage of your turnover is going to be the profit. So it's a presumption, it is not actual. Presumptive taxation can only be applied by taxpayers where their turnover, and provided you have cash receipts of less than 5%, right? If all your receipts are in cash, then your limit is lowered to 1 crore. So for taxpayer having his business income of 1 crore in cash or 3 crores in non-cash, those people can apply for presumptive taxation. And here we are talking about only income from F&O transactions, which should be from normal business channels. If this be the case, then your profit will be 6% of this turnover. That is the limit.
And what are the most common mistakes, or let's say the costliest mistakes, that you've seen such taxpayers make while filing returns, particularly those with multiple sources of income? And what can be the consequences of getting this wrong, of not making certain disclosures or making errors? What can be the consequences?
So I would say one of the basic mistake which many people who are not accustomed to this kind of income, trading income, they actually report their income in a wrong ITR. That is the basic mistake that is being done, because when they get their brokerage statement, they read everything as as a capital gain. Sometimes their trading income is not even significant enough, so it's overlooked and it is reported as capital gains or income from other sources. So the basic choice of ITR becomes incorrect there. And what happens is that obviously the ITR 1 or the ITR 2 does not have those kind of details for reporting those particular amounts, which is where the details, since they are not reported, they are overlooked and it becomes a defective return. So many taxpayers make this basic mistake where there may not be a substantial difference in the tax rates, but still the return will be rendered defective. Also, what happens is that you are permitted to carry forward the losses in case of trading losses for 8 years to be set off against your future incomes. If you do not do the right kind of reporting, then you're actually losing out on that carry forward as well. So this is the first thing which is commonly seen, especially in case of small taxpayers, where the income may not be significant. The second mistake is also that people don't file their returns in time. They do not have adequate preparation done. So, which is where many of the sources of income are either inappropriately reported or not reported, misreported. And then, later on things come to surface where they have to pay tax plus interest plus penalty at a later point in time. So,
While filing belated returns, you mean?
Yes, while filing belated return as well. Or even if they don't file a belated return because they might miss a source of income. So either you're filing a late return or you're filing an incorrect return. The second mistake is many people believe that opting for presumptive taxation is so easy because it's a percentage of your turnover and that's an easy way out. which is correct, because you don't have to substantiate the amount of expenses, have supporting documents and things like that. But they have a long-term implication in terms of maintenance of books of accounts, or they also have when you're coming out of presumptive taxation, let's say because one of the years you incur a loss or you show a lesser profit, then in that case you might have a trigger for a tax audit, which many people fail to realize, right? So this could be, I would say, second highest reason for having a challenge on this.
All right. And finally, if you could also talk about the consequences of missing this deadline. What if somebody is unable to file their return by August 31st?
Right. So if you're unable to file the tax return by August 31st, first of all, there is a penalty which is attached with the belated tax return, right? So that will be immediately applicable to you. The second is the power to actually carry forward the losses to subsequent year. If you have loss from any source, that gets lost. You cannot have a loss carry forward. You have to give up that loss. So that power is also lost. Also, if suppose somebody is wanting to change their regime. Now, this is a little difficult because if you have business income, you are not able to change the regime year on year basis, unlike a salaried person who has the choice of changing the tax regime every year.
All right, then. Thanks a lot for joining us today, Ms. Raote. And I'm sure our listeners will find your insights very useful ahead of the ITR deadline.
Thank you, Preeti. Lovely talking to you.
So August 31st is not simply another filing deadline. For taxpayers juggling salaries with trading, consulting, or freelance income, choosing the wrong ITR or miscalculating turnover can have consequences years later. The takeaway? Reconcile your records, understand what counts as business income, and file correctly and on time. That's it for today. You were listening to this episode on The Morning Brief. It was produced by me, sound designed by Indranil Bhattacharjee. Keep following our podcasts on your favorite platforms.